Good morning, everyone. Welcome to Admiral Markets and this is a strategy webinar of a live webinar of the 21st of January. We're going to take a look at some interesting and various things today, including the 21 band and also price action on the 50-minute chart. Before we do that, though, this disclaimer explaining the fact that, this risk disclaimer, actually I'm missing one. No, this is actually a different disclaimer. This is the disclaimer explaining the fact that this online webinar here, of course, is intended for a global audience. Please take into account that it may not be suitable for everyone. To find out if it is or isn't and other details, please visit admiralmarketsglobal.com, select your country of residence, and then contact an appropriate entity. Excuse me. Also, please be aware of the fact that trading for exchange and other financial markets is considered high risk and may not be suitable for all traders and investors. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. By continuing watching this webinar, you agree with the disclaimer mentioned here, and you can always request a copy of this disclaimer by contacting an appropriate entity of your residence. Alrighty, today's focus on strategy, so we'll be using different things. I wanted to focus, in fact, on using a 21 EMA. All right, so let's do that. But before I do that, actually, let me quickly take a look at what news events we have and what risks we could have connected to that. We have Bank of England is going to share the number of votes that I know at the top of my head. We also have Bank of Canada with the interest rate, and tomorrow we have ECB press conference. So the euro could be very choppy today in anticipation of that news event, and the pound could also be very volatile, of course, today. So it's something to be cautious of, and I don't think anyone would want to trade the pound with the MPC meeting minutes and this list of news coming up, nor the CAD, because it has an interest rate. And tomorrow, and even maybe today, the euro, because it could be quite a quiet day for the euro. Alrighty. Because of all that news event, I think it's actually a perfect day for strategy, and not maybe a very good day for analysis. Why? Because there's going to be a ton of news events. So if there's one day that we can really dive into some strategy, I think today is an excellent day. So let's take a look. I want to just take a look at only the moving averages, not even the pivot points. So I don't remember what template that is. Let me make a quick template. Let's see, maybe I can find one. Let me check this one. That's a bit too crowded. Sorry about that. Didn't think about that beforehand. Okay, let's use this one, but I'll remove these. Make this 144. So we have a 144 EMA close. If you're new in here, by the way, please let me know. That's always good to know. We have a 144 EMA close, and we'll make this 21. We have 3 times 21 EMA high, low, and close. All right. The 21 is starting to be a bit more of our favorite than 34. 34 it's nothing wrong with 34 necessarily, but it's very nice how 21 kind of is a very close contact with price. All right. So let's take a look at, let me save this quickly, and then we will get going. And this is, of course, you can see how nice, first of all, the charts look like here. When you have the 21, you can see price is either nicely below it. That's a very strong trend. If it's above it and still below the 144, it's correcting. And of course, if it starts to break above 144, then it's a bigger reversal. But as long as basically price stays below 21 and 21 is below 144, we're in a very strong trend. And the opposite, of course, if it's above it for an uptrend. If price is kind of in the 21, then we're probably at a bouncing spot, like here and here and here and here. But sometimes you don't get the bounce. You get a bit of a bounce, but you get a bigger correction, right? But here, 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 they're all moments where price was stopping at the 21, right? But sometimes you get a bit of a peek through, like here and here and here. So first of all, this is just a quick visual idea of how you can use it for trend support and resistance as well. Very useful. Now yesterday and the last few weeks I've been talking about using it as a breakout by waiting for a 1 hour candle to close below the 21 band. Right? But that depends on the moment when you do it, because obviously there could be moments where the price still makes a bigger reversal, right? Like here, for instance. So it's never going to be a fail-through system. No, not ever. One system will never be like that, of course. But that set aside, yesterday then I shared the idea of waiting for double dip to the 21 band, right? Waiting for 1 and then 2. There are times that it's not going to happen because price just continues. But if it does happen, it's usually pretty good. Gives a bit more confirmation. The euro-dollar actually made a double dip yesterday. And the 1 hour candle that closed below the band yesterday was at 115.75. The market didn't move too much, only about 40 pips before it went up again. I guess, I don't know, it's just a guess, but maybe the lingering news event tomorrow could dampen the enthusiasm for price to move a lot before the news event. I don't know. In this regard, we're seeing some turnaround again at this point here. So if it does turn around, it could be good maybe to put the stop loss just above here and try to exit soon. As soon as it dips here, maybe into the 150, 125 zone or 151. Oh, not 51, sorry. Getting these numbers mixed up. 115, sorry, 115.25 or 115.00. But it will be a good example of a double dip. Let's take a look at more example yesterday. The Euro-Yen 15-minute chart, right? Basically, if you look at it, here you see, wow, it's a bit confused. I understand. Sorry, 1 second. Okay, the turnaround happened here, 5th of December, and we've had a downtrend ever since. We had a pretty big consolidation here where the moving averages were a bit yucky, right? But once it's trending, you can see how nice and important they are. Here you can see that, of course, we are exposed sometimes to consolidations. That's where a loss certainly at times could happen, or two. But we have to gain it when we're in a good trending mode. Let's see, here we had a double dip. Here we had single dips. Here we didn't even touch it. Here you had a double dip. Here you had a double dip. It was pretty soon after the previous double dip, but okay. Here you had a double dip. I guess it's still okay-ish, although price moved a bit far away before it made the double dip, so not that clear. Here was a single. And then we had again a double one. Why? Or maybe even a triple. So this is one where if you took this one actually, right there, it would have been a loss. But then you hopefully take this one and you compensate it. Of course, it could be so that you catch the first one and you don't catch the second one. It could also be so that you don't catch the first one, you catch the second one. Then you're, of course, in a better shape. Those things can, or if you catch both. If you catch both, you're still in profit, or will be in profit probably. Because the second moment here was at 136.86, 7. So going up at 100 pips at the moment. The stop loss, I would say, it's okay to put it above this one here. Why this fractal? Because the fractal is still above the band. Another good example was the dollar CAD. As long as the 21 band doesn't touch the 89, the 144 here, it's okay, because there's still some space. Once they start to get intertwined, it's a bit of a danger zone already. Right? So where does the double dip here? We had 1, 2. There's a double dip. So then this was the signal. And here, if you were lucky enough to take it to blue, it was even a discount. The stop loss was not in danger. And we get the good upside here. So those are good examples. The Aussie is a good example that is a good example of not that interesting price action, or moving averages actually. First of all, now the 21, and for already quite a while, let me take a look exactly. For about a day now, at least more than a day, the 21 and 144 have been intertwined like this. So it's been quite a choppy Aussie chart. When you look at this this time frame, it doesn't look that trendy. It doesn't look too appealing. Now you can do this basically. I mean, I think the 1 hour chart is a good one, but you can really use the idea on all time frames. It's not limited to any time frame necessarily. And we can even take a look at the 50-minute chart. Probably see a bit more opportunity in a shorter period of time, or maybe, yes, same number of bars, but of course less time. The 50-minute chart doesn't look well set up. Well set up in the sense that you have some trending mode going on. At the beginning, you want to be careful with trying to enter a new trend, because sometimes the new trend doesn't go anywhere and you get this kind of consolidation. And you get caught in a trade that doesn't go anywhere. So better to be always a bit on the safer side and be more cautious at the beginning. This does not provide many trading opportunities, many high probable trade opportunities. In fact, we don't even, if we see, sometimes we don't even see double dips because it's just prices just breaking away. If you see a few of them like here, the moving averages are still intertwined. It's quite messy. So let's take a look at something that's looking a bit better. Maybe the dollar CAD. Okay, dollar CAD is looking good. So what we want to see, we have a high AO rating. And we want to see price pushing up, then down again, and then up again. And it should definitely be ready because this is a big AO. Of course, it has the CAD, so it's not the best of examples, perhaps, because of the CAD interest rate. So I'm personally not trading currencies that have an interest rate. So it's, but I mean, I'm using this example because it's just a very strong impulse here. That's an extra benefit that is very useful in the analysis. Let's see, I'm not sure if I understand. Björn, good afternoon. Jörg, by the way. Good to hear from you. Let's see, Björn, hi too. Let's see, can we just find a pair that has been trending down or up? and just buy and use. You mean like do a small little test? Sure, we can do that. I think that's what you mean, right? Let me know. Now, mind you that in general, I think this is best to use when still using a top-down approach. So, you want to scan the market and see which pairs are interesting in general. And then you can use this approach. I think if you only use this approach, it's kind of has a drawback that you don't look at the bigger picture. And it becomes a bit more mechanical, which is not bad necessarily, but I think you're going to bump into trades that maybe could be avoided if you look at the whole market and decide which pairs you're interested in before using this. Let me say this. So now that's what I usually do, right? But now I'm just focusing on this technique. Sometimes it is difficult to avoid this choppiness, but I think in this case, most of the time would have been avoidable. If we're looking for the 21 not to be touching the 144, then many of these areas price is not really interesting. On top of that, if we're looking for a double dip and a close, then these two didn't even close below the 21, right? Here, the moving averages were still touching. Here, there was a double dip, but to the opposite side, to the upside. But that's not good because the 21 is below the 144. So we are looking for them to be aligned, right? So that all this, if you look at the rules and guidelines, then those would have not been setups, even though it was very choppy and it could be dangerous. In fact, it's good that we were able to avoid it in a way, right? If you look just purely at the fact that you have a double dip, then this could have been a setup here, and also here. And both did pretty well. This is all chopped, they're all intertwined, so we skipped that zone. This is 50-minute chart, mind you. Here we have a double dip. Here's the breakout candle. How you define double dip is sometimes something that is very clear sometimes, but sometimes is a bit of a doubtful cases. For instance, this was a small dip, this was a big dip. Still, it's a double dip, so you could count this one, I think. The trade management, of course, is still very important, right? You don't want to lose. You're not up a lot on this trade, but you're still up about 30 pips. I know that doesn't sound much for a 50-minute chart. Of course, it's not bad compared to the risk of about 30. And you want to be attentive of turnarounds, of course. And I think you see enough signals that there is maybe some lack of steam here. So I think it's definitely not going to be a loss there. Well, this is one of those cases it just was too fast to enter. There was no double dip there. Here, this is one of them. And this was one that would have had a tough time. If you used a tight stop loss, you lost actually on that one. If you use a wider stop loss, if you go below this bottom, it's a very close call. Could be a loss, but it depends how. If you go 2 or more pips, it's a win. If you go really 1 pip below it, it's a loss. I usually personally go always not exactly 1 pip below it, so I probably would have been okay with it, although it was tight. Yeah. So anyhow, this is this is if you really look strictly at it. I think this is what you mean, Björn, right? That you look at it strictly. You were even talking about, but I'm not. You didn't let me know. I think what you meant was to take a pair and just test it, right? Is that what you meant? Jörg is saying that Dorian is his favorite this morning. We'll take a look in a second. And that Kaden says that these examples are helping. That's great. And don't get me wrong, it's not a fail proof, of course, because here we had a candle that just barely closed above it, and however still turned into a loss because we did have a double dip, closed just above it, unfortunately for us, and then still moved lower. But here's a double dip again. That was a very good trade, as you can see. Here's a double dip, but it doesn't count because the moving averages are intertwined. Personally, in my opinion, if these are two dips pretty close to each other, so this is the breakout trade. But I wouldn't then count this as a double dip anymore. Once we have a double dip like this, you kind of start from scratch again, if you know what I mean. So then this is one move, this is a pullback, right? And we never get the double dip. So this is a single because this is one move here. You can, of course, use these moving averages like this on even 2 time frames or 3. It does become a bit more maybe complex to piece the puzzles together. What could happen, for instance, is that on 1 time frame we have bullish moving averages. Let's say that moving averages are like this, bullish on a 50-minute chart, and you get the double dip. But an hourly chart, what could have happened on the hourly is that actually you have the 21 EMA pointed up and prices above it, but the 89 is coming down somewhere here. That does not necessarily have to ruin the trade setup though, because the 21 could be used as support, and actually price could use it to get up to the 144 and kind of close the gap on the hourly chart, especially if there's divergence. So just because the hourly price is, let's say, above the 144 and 21 on the 50-minute chart, but it's only above the 21 and not above the 144, doesn't mean it has to be a bad trade. It would, if they are both aligned, it's great, of course, I'm not saying. If they're not, it could still be good circumstances to consider kind of a 1-hour reversal trade where price goes from the 21 up to the 144, especially if there's divergence. And the picture could be totally mixed. It could, on a 4-hour chart, it could be totally different. It could be, or the daily chart could be different. Let me think for a second how that could match. On the daily chart, for instance, we could have actually price being above all the moving averages, but what we're just seeing is a correction back to the 21 band. So what looks like a downtrend in the hourly is just a correction on the daily, and maybe soon we'll be bouncing up again. So you can really use these moving averages to get an entire picture. The only thing is that the entire picture might seem confusing at the beginning because there's so many different states of where each currency pair is on all these time frames that I would advise to start slowly. Maybe focus on 1 and then 2 and maybe 3. And I don't think you really need more than that. You could, of course, always include everything if you wanted to, although it's certainly not needed. Alrighty. Let's see, in those situations, which side do you prefer? Now I don't remember exactly which situation I was talking about. You mean when we are closing the space between the 21 band and 89 EMA on the 1 hour? Is that maybe that situation? Well, you could either wait for price to get up to the 144 and start looking for reversal trades, or indeed take the reversal trade. I mean, not take with the trend reversal trades, let's say. I guess it certainly depends on divergence. It's a very important factor. Is there a strong support and resistance level close by that helps, for instance? What kind of confluence do you see? The more confluence, the better. It certainly has its bit of its risk because you're going against the 1 hour trend. But let's say the daily chart is indeed an uptrend. Well, then it certainly has better odds because of that, right? So it's I don't have necessarily like a formula that would say I'm looking for this, this, and this. But basically the answer, I guess, is confluence. The more, the better. And what is enough is a discretionary judgment. But divergence in general, besides confluence, divergence is very important. That's sometimes why maybe even looking at one time frame is just makes things simpler because you just focus on that. Although looking at a wider broad of market and narrowing the list for today is, I think, also a useful tactic. If you're looking for 1 hour chart, then it will be 1 hour divergence. Preferably at least one. I mean, best would be even two, I guess. But if there's and also 4 hour divergence, it will be good. 15 will probably be there if the 1 hour has divergence. You can double check it, but it should be there too. So it's kind of like a summary of factors that weigh, and you kind of make a discretionary conclusion. But in general, the best is to focus on with the trend setups at first to get into the routine of things. The reversal setups, when you take it from one moving average to the other, or you trade it to the moving averages, are always a bit more riskier. Let's say prices, indeed in this situation here, far away from both moving averages. Trading it back to the 21 band is also more dangerous. Trading it from the 21 band to the 144 is more dangerous. Trading it away from both is with the trend and less risky. Okay, Björn is saying, take a look at the dollar CAD 1 hour chart and zoom out, and when you see it has a trend up 200 pips, buy and hold it till it breaks down under 200 MA. I'm not sure if this is what I'm still a bit confused. I think you meant it as advice, or maybe, because what I'm using is 144 EMA, not 200, but maybe it's not that important, just wanted to let you know. You can use a stop loss at 144 EMA. Indeed, some cases it could be a bit wider than basically. Oh, it didn't work. Okay, I think it's a bit wider than maybe need be. I think that if you have a double dip, you can use a tighter one in general. All right. Euro yen. I can do that definitely. Euro yen as an example. Let me see. Here, right, this one. double dip and took the short. There was another double dip there. Let me think. No, this was, pound yen was, this is a 50-minute chart, sorry. I took this break here on the pound yen as well. The 21 band does sometimes a pretty good job. Here you would not have had entries because it never broke below the 21 band. Whether this is a double dip is a bit questionable because the move into the band, why? Because you had a move above it, but you never had a solid move below it. You see that? So this is more like one move. This is, I would not consider this a double dip here. This here is different. So this could have been the breakout candle. And despite the strong pullback, if you put a stop loss above the fractal, it would have survived for the fall, in fact. Let's see what else we can take a look at. The Bjorn was talking about dollar yen, so let's take a look at that. If you have also a preference, let me know. Dollar yen at this moment, I mean, from a moving average point of view, it's actually retracing back against the 144, right? The 144 here, kind of being an equilibrium line almost. It's a pretty good equilibrium line, in fact. 4-hour chart, we don't have a double dip there. I mean, if you look at it from that perspective, in fact, the daily chart could have a breakout trade if you have a daily close above the 21 band to the upside, right? But the 4-hour doesn't have anything. The 1-hour neither. From a moving average point of view, we don't have any trade at this point. From a technical point of view, it could be different, but from a moving average point of view, we don't have it at the moment. The daily almost. The 50-minute could have it if we push up, push down, push up, and then again down, right? So I'm not sure if everyone is necessarily enjoying this specific discussion about one strategy. Nor we do try to look at the market as well in combination with the strategy. But because today I'm not too interested in what's going on at the moment because of all these news events personally, I thought it would be a good time. If you have a particular pair you still would like to take a look at here, let me know. And then we can take a look at what's going on right now on that pair. But I'll leave that up to you. I'll leave it up to your initiative to do that. Otherwise, I'll just focus on strategy today. What is actually the topic, in fact, of the webinar, but usually we do tie it in with market movements, quite strongly, in fact. Let's see, Kalian says excited about the strategy. That's great. It I think makes it a bit more cautious by waiting for double dip instead of a single dip. So I think that more confirmation is can help with catching some of those false ones as well. Let's see. And Kalian also added, I think in this strategy you enter right at the moment may not be at the right place. Let's see. For example, yeah, sometimes it's too early. It will not continue breaking. Indeed, could have a small retracement. The dollar CAD is a good example, where here was the entry, but we had a dip after that before we moved up. Sometimes you don't get the immediate. Let's take a look at the euro pound. Let's see. 76.40. All right. Let me see what time frame you use. What time frame did you use for this chart? That was the 1 hour. Okay. Let's see. I'm not sure if I would consider it a double dip, but you don't have to wait for a double dip necessarily. Whether this, the thing is, what I would like to see is often price make a bit of a move below it and then above it again. This is kind of like one movement, so probably wouldn't consider it a double dip. But still, doesn't mean it's off the table because of that. Definitely, if you look at the bigger time frames and you think it's still a good correction, for example, and you think it's a good breakout, it's still a way to trade it, indeed, especially if they're lined up this neatly and you have good AO power, indeed. So the breakout candle below the 21 band is 76.62-ish, 61. Short at the 76.40 means that you took it a bit lower, right? I'm not sure if you just saw it at that point or why you took it a bit lower. You managed to get 25 pips. That's good because it did turn at the spot where you took profit. And you're asking, I'm not sure what your question is actually. You're observing the fact that the price is going sideways, right, for 6-7 hours, which indeed it's kind of making a bear flag. But that's not strange because when you have impulses, you're bound to get corrections, and the impulse won't last for a continuous. I mean, it will have its corrections and continuations. So I'm still. Let me know what the question is. I'm not 100% sure, or maybe it's a comment. Okay, got it. Yeah, yeah, that will happen. Those consolidations. You book profit pretty accurately. In fact, it's nice to get the profit before you get through this consolidation. Although it could always continue, of course, and probably will, to be honest. But it does depend on the pound news, which one might not want to actually live through. So that makes sense. All right, let's take a look at another chart. Okay, you took a fib. Okay, cool. Let's see. Pound dollar, for instance, is not a good example, but you can use it also on different time frames. 4-hour chart here. It's a bit unfortunate how the breakout happened right here. Here we had a double dip, and the candle that closed below it was all the way here, unfortunately. It's been unlucky because if this candle, the candle previous to that was just a bit lower, we would have entered a lot better. That can have a difference sometimes, but still, as you can see, plenty of space to fall. Some of these are going to be not as good. If you look at this pound dollar 4-hour chart, you can see that here was the first double dip. This just missed to be a double dip, was very close. Here was one. Here was another one. This one I would not say was a bit of a question mark if it's a double dip. Probably not, right? Then here it would have been, but that would have been actually not so good moment because it turned back pretty fast after that. Here's another one. So those are all 4-hour. You can use this as a swing trade as well, right? 4 hours. This one we already talked about here, I think. It's all in the pound dollar. This is a bit of a tricky zone because here you definitely can bump into a loss. If you don't spot the bigger support level, that might warn you of the fact that you can get this consolidation. It's going to be a danger zone. Sometimes you can get that warning with, indeed, looking at support and resistance. This I would not consider a double dip, by the way, because it didn't go into the 21 band enough, in my opinion. This is a breakout, though, right there. That would be a double dip. And yeah, probably would have been a small loss or break even or small profit, depending on how you exit. Here we had again a double dip. So here's the breakout. And that one is not doing that bad, in fact. And here another one. So actually that consolidation zone was pretty, survived decently. And the pound dollar had recently another one right in here. If you're unlucky, this one right here. That is possible that someone took a short there because they could consider this to be one dip and this to be one dip and this to be the second. Just because here we had one candle that pushed through it. And yeah, one candle is always a bit difficult. Yeah, the thing is that preferably I would say we see some gap between price and the 21. Preferably we see a couple of candles at least, preferably. There are going to be, of course, as I said, situations where it's not perfect. This is a perfect example, I would say. This one, because there's only one candle and it closed marginally below the band, it is, I think, a very questionable one. So you can see the difference now. It doesn't mean you have to always avoid those, but you can see sometimes I think there's a bit of a more risk attached to those. It's definitely possible that someone made a loss here, but it's also definitely possible to have avoided it. Let's see. Kayleen is talking about a fib. I think this fib probably. Maybe it's a lower fib. The 38, no, it is this one. 38.2 fib. Yeah, that seems likely because we have now, well, if we get there, we would have a double dip probably. This is one. We're getting a few candles right now below the 21 bands. If we pop up again, it would be the double one probably. And if we then start to break below again, it would be the breakout. Of course, the breakouts, I mean the consolidations are always dangerous zones for breakout and trending traders. You know, normally what you make in trending areas, you give substantially a lot back in consolidation zones, at least if you're a trend trader. Of course, if you're a consolidation trader, you make money in consolidations and you lose it in trending environments, right? That's the typical standard message that you will hear in it. Certainly very true. And at least if you're a candlestick trader, of course, it might be different. You might be trading all these environments. So I think this method doesn't do a bad job by not trading it when the moving averages are intertwined, when trying to keep an eye when using the double dip, when trying to see if the bigger market environment by using confluence and trying to see, preferably if there's space. It's not always going to be perfect because look here, here we had only one candle, two. I would consider, by the way, one extra thing. If if it goes back all the way to 144 EMA, it's also a bit different than if it double dip or back to 144. Because if it goes back to 144, especially if there's been a big gap, it already indicates a pretty big consolidation. Let's take a look at the daily chart, perhaps. You can see that the euro AUD is really not in a position at the moment. It was, let's see, where was it? Maybe here. I know that's difficult to see probably for you, but here we had one, and here had a very small one. It's very questionable, but especially if you see then this, it's questionable if it's a double dip, but okay. It still could be a good breakout, though. This is a daily candle that could be worth it. This is one of those double dips that is like the pound dollar, a bit short. This dip here, but it also works out well sometimes, as you can see. In general, though, one could consider this to be a double dip, by the way, and then it would still be the same point here, or here, by the way. The high in this case, the first case, got broken by 30 pips, so that would have been probably a loss if this one is taken. Yeah. Let's see. Any other examples? Here we had here we had one, in fact. here, potentially. Those would not be good. Let's see. Here and here. One was a good one, wasn't. This doesn't look like it has anything. I'm going a bit faster now, maybe, but quite choppy here. Oh. Here's maybe a single breakout. It's choppiness again. Here's a lot of them. I'm going too fast. 1 second. Here could be a lot of them. A lot of 21 band touches and continuations. Right? All the way down here. So that's a very good zone there. Let's see. How about trading on side where C breaks? Like in ABCD, if C breaks A short side, if not long. So if let me try to make sure I understand you correctly. You mean if you have this ABC as I call it, you mean about trading the long from here to here? Is that what you mean? Yeah, you can do it. You can actually, as I said, in the hourly, for instance, if you have the moving averages up into 15, and the hourly would have them up 21 EMA up, but the 144 would be down. You're actually trading the C part, actually, most likely, because price would have been breaking above the 21 band. That's the A. It will go back to the 21 band. That's the B, and then bounce is actually that C part. You could trade the C part by trading the bullish 50 moving averages, actually, that are translating into the 1 hour bullish 21. See what I mean, right? It could be, that's universal for all time frames. The bullish moving averages on the 1 hour chart could be the reversal bounce, C bounce on the 4 hour. The bullish 4 hour moving averages could be the bullish 21 going back on the daily to the 144. Another way of doing it, if you think these are too many moving averages, by the way, I think that it's okay to take off. I mean, it's up to you. I like the 21 band because it gives me a footprint, a wider footprint, so I know it's like more of a zone. If you don't want to use it really for entries, but more for other things that I also use it for in regard to trend and filters, one could take away the high and the low, and you have less footprint, but you have maybe more clarity on your chart, 2 moving averages. You really have a good guideline what's going on with the market like this. But to me, it becomes less footprint. I do think it's less visible. The other way would be even to take the 144 away and just use the 21 and price action. I think the 21 alone, even if you're a price action trader, I think it's always good to add a 21 just to see the current momentum. Let's say you're trading price action on a 50-minute chart. I think it's still good to have 21 on the chart just to see what the flow is of the moment. Maybe add an RSI to see if there's something oversold, for instance. Let's do that. Of course, oscilloscope you can also use for divergence, but I think with the RSI you get a bit of a better idea what the smaller moves are doing. Let's see. Let's take a look at yesterday's trading. It's pretty choppy, in fact. Well, ideas you can look at, for instance, is candlestick patterns below the moving averages like this one here. You probably want to trade with the trend unless you have higher time frame reasons. But if you just focus on the 50-minute chart, you want to look for a price action kind of in the direction of the 21 EMA, like here as well. An impulse, pullback, and you see price action bounce. Price didn't go all too far, as you can see, so you have to be quick on your feet, I should say, and not to exit too late. But this is a pretty choppy chart, so there's a few examples I could see. I'm not looking for reversals to the moving average, right? So this pin bar is not one that it's actually not bad, but necessarily, but it's not the one that is part of his focus. Wait, let me do something quickly here. Let me save this. Euro-dollar yesterday, let's see, right in here. This, I mean, perhaps could have been already a wick off of the 21 band, it was just in place, so it's kind of early. But if you take a wide stop loss, it still would have been okay. And you can see here how price reacts to the 21 band. I don't do this a lot, but I mean, I'm just showing you that you don't have to use all four moving averages still to use the 21 in a good way. I think that my point is that you can use 21 EMA in multiple manners. You can use it very simply as just one EMA, and I think it still could have a pretty good value in combination maybe with other tools or price action. That's my point. If you do like the four moving averages, then of course no problem. You can leave them on. It's not an issue. But if you think it's too busy for whatever reason, then this could be still a solution for you to have a pretty good reading about the flow of what's going on now, but with less busyness on your chart, if you see what I mean. Right? That's my point. Any questions by any chance? I think preferably you want to see a sustainable move above the 21 band, not something where it's just turned, because it could flip a few times if that happens. Oh, the arrows on the candles, some of these candles are fractals. Fractals, you can find them by going to Insert, Indicators, Bill Williams, and then click Fractals, and they indicate minor, let's say minor tops and bottoms. Some of these fractals are going to be major tops and bottoms, but all of them are support and resistance spots. Why? Because basically the definition of support and resistance is that you have two candles to the left and two candles to the right of one particular candle, where the low of the middle candle is lower than the low of this middle candle is lower than two candles to the left and two candles to the right. The high of this candle is higher than two candles to the left and two candles to the right. That's the minimum. If that happens, you have a fractal. It could be more though. It could be 500 candles. It could be 50. It could be 3. It could be 5. But the minimum, when you have two candles to the left, two candles to the right, where the high is higher than the other two to the left and to the right, or the low is lower than the other two candles to the left and to the right, you get a fractal on top of it. That means that candle, high or low, is a support or resistance. No problem. I'm happy that's clear. It's not, I don't think anyone must need it necessarily, but it's just for me easier to see where those levels are if you have it on the chart. Otherwise, I'm still like, is it to the left or to the right? You know, it's kind of like squinting your eyes, and with this, I don't have to do it. No, I decided not to trade the euro dollar. Let me take a look. I actually made a second dip, or, well, it's true that these candles didn't really move away from the 21 band that much. But I also look at the coloring of the moving averages. Here they definitely turn red. So that's another advantage. There are kind of a few factors. It's space between price and moving averages. 2, how many candles. And 3, the change of the moving average band. Here you did have the band go down again into red. So this has at least one of the 3 things. I don't have an exact formula that says I need this and this or this and this and this for that. But if you consider this to be, of course, the gap, then we would get it closely, or we have it actually maybe already. Let me see. Right here, indeed. That could be a short indeed right now, because that would be a double dip like that. But the stop loss I wouldn't put here, because this is not a fractal as yet. It would have to be a couple of pips above this level. Let's take a look at the 15. The 15 showed a double dip too, by the way, already earlier. 1, 2, 3, and here's the break point. So the euro dollar is showing it on different time frames too. Not the 4-hour, but the 4-hour is, of course, obviously very nicely below the 21 band. I'm trying to think if there's any angle that I haven't thought about. Well, I guess if there's a really strong AO reading, that's very useful, because then you know that the momentum is on your side. That always is very, very good. Let's see, this is the Euro CAD. Well, this is definitely a difficult one. This could easily be a loss here, right? You have that double dip, and then the break below it. In fact, the stop loss, by the way, I would, if you break below here, I would rather go above the 21 band. So these fractals are pretty tight here. Therefore, rather go above this one. Oh, and one thing is that if you see a failure of the double dip, and you see a pretty strong candles now above the 21 band, you might want to consider trying to exit for less than your, than not even waiting for the stop loss to get hit, depending on the exact circumstances. Now, the exit part is a whole different subject again. I prefer to have at least some target in mind and aim for something. The stop loss, trail stop loss, is sometimes useful, but you want to be careful with not moving it too quickly, though. If you're trading a 50-minute chart, I think exiting quickly when you think the energy is gone is pretty handy. On a 1-hour chart, I have the tendency to be a bit more forgiving and try to see if the pullback is just to move up or move against my trend is just a pullback, especially if there's no divergence yet. Because the hourly can typically move like this, still down, but a lot of chop along the way. So if you suffocate the trade, you're not probably going to get to the target too often, because it makes too many choppiness along the way. And if you then trail stop it too quick, it's just not going to give enough space. Of course, it's different if you get really close to your target. Then you might want to think about a tighter trail stop, not to give too much profit away. I mean, if you're aiming for, let's say, plus 180, and you're at plus 160, do you really want to give up? Do you really want the trade to get, let it get back to zero? Probably not. So you might want to keep an eye on price action at that point. And if you see candlesticks that are potentially showing a turnaround, well, then maybe you want to get out indeed at 150, 160 instead. I guess lastly, the very last thing that pops up in my mind is you can use this. I mean, it depends how you want to use it. You can use this as your, if you want, you can use it as your base. And so I'm going to scan the market with this vision, right? And then if you see an interesting double dip, then look at the broader market and see, does it make sense? That's one way of doing it. Or you could first look at the broader market and focus on the pairs, and then see if this technique will help you on that pair. Right? You can make this your focus, or you can make it just like an extra tool. I use it as an extra tool. So I use it the broader market and look how this fits in, and then use, depending on the situation, use other tools as well with it. it's if one would really focus on this and use a lot of time frames and a lot of pairs, I think it should be okay. You just want to be careful of not maybe chasing too many trades, but still kind of analyzing the situation. I think that is important. I think it could be treated as discretionary. Sorry, non-discretionary. It could be treated that way. I'm not sure if how that will stack up though. You know, I've treated it always more as a discretionary thing. So I just don't know. Maybe it's actually okay like that. So one thing though is that if you use a lot of time frames and you lose a lot of currency pairs, of course you're scanning a lot of situations, and then you'll probably find a time frame and a pair that has a good structure at that point. All right. So I guess those were my last ideas that I still could think about regarding any angle that I might have missed. If anything still pops up, I'll let you know next week. Regarding our webinars, tonight Nenad is going to take a look at which market conditions to avoid, 5 p.m. GMT time, and tomorrow 5 p.m. GMT time as well. Nenad and I are going to take a look at fading the momentum for reversal setups. So hope to see you then. Wish you good trading and happy hunting in the meantime, and see you all soon. Cheers.